Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
All right, welcome everyone. Today we're diving right into the deep end, talking about one of the trickiest areas for any global company, accounting for income taxes. We're not just scratching the surface here. We're going to get super technical and really unpack the mechanical differences between US GAAP's ASC 740 and IFRS's IAS 12. So yeah, this one's definitely for all you pros out there who deal with this stuff day in and day out. So here's our game plan. We're going to kick things off with the one big principle that both standards actually agree on. It really sets the stage for all the drama that follows. From there, we'll get into the weeds, breaking down all the key differences one by one, from how you recognize an asset all the way to where the final numbers land on the financial statements. So first up, let's talk about where everyone's on the same page. This is the bedrock, the conceptual starting line for everything else we're about to get into. Both ASC 740 and IAS 12 are built on this one idea, the asset and liability approach. And the logic is pretty straightforward. If you've already recorded something in your financials, you also have to record its future tax effects. That's what creates your deferred tax assets and liabilities. Oh, and one other key point of agreement. Both standards say absolutely no discounting these balances to present value. Okay, so that brings up the big question, right? If they both start from the exact same fundamental idea, why are we even having this conversation? Well, the devil's in the details. It all comes down to the application, the nitty-gritty technical mechanics of how you put that principle into practice. And trust me, that's where things get really interesting. And that brings us to our first major split in the road. This is arguably the single biggest mechanical difference between the two frameworks, how you account for a deferred tax asset or a DTA. Okay, so under US GAAP, it's this two-step dance. First, you go ahead and recognize the full deferred tax asset, the whole shebang, right on your books. But then comes step two, which is kind of like a reality check. You have to ask yourself, is it more likely than not that we won't actually get the benefit of some of this? And if the answer is yes, that's a greater than 50% chance, then you set up a valuation allowance to knock the DTA's value down to what you actually expect to realize. Now, IFRS looks at this completely differently. It's just a single step. You don't book the whole asset and then reduce it. Nope. Instead, you only recognize the DTA in the first place up to the amount that it's probable you'll have future profits to use it against. So that whole concept of a valuation allowance, it just doesn't even exist under IFRS. This table really sums it all up. You've got two totally different philosophies to get to a similar place. US GAAP is all about recognize, then impair, which gives you that explicit valuation allowance disclosure. IFRS, on the other hand, is only recognize what's probable, so the judgment call is baked right into the initial number. The final asset on the balance sheet might look similar, but how you got there and what you tell people about it is a world of difference. All right, next up, timing. Let's say a government changes the tax laws. What's the exact moment, the trigger point, for you to reflect that change in your financial statements? And here's another one of those subtle but critical differences. US GAAP is super strict. You can only use tax rates from laws that are officially enacted as of your balance sheet date, period. IFRS, though, lets you look a little bit further down the road. You can use rates from laws that are enacted or substantially enacted. That basically means if a bill becoming law is just a formality at that point, you can go ahead and use it. So what does this mean in the real world? It's pretty simple. A company on IFRS will often recognize the financial hit or benefit of a tax law change earlier than a company on US GAAP. They could even be in different reporting periods. You can imagine how this creates major headaches for comparing companies during a big tax reform. Let's switch gears now and talk about a few very specific types of transactions. These are the kinds of nuanced rules that can really catch you off guard, even if you've been doing this for years. We'll just do a quick flyby of these four technical differences. You can see how the rules really start to diverge on common corporate stuff. Like with leases, IFRS has a special exemption that US GAAP doesn't. Or for your quarterly reports, GAAP says use one worldwide tax rate, while IFRS makes you calculate a rate for each country you're in. Every single one of these can create a pretty big difference in the final numbers. So, we've figured out what our deferred tax number is. But the next huge question is, when that number changes, say because a tax rate goes up or down, where do you record that impact? Does it hit your net income, or does it go somewhere else entirely? Let's paint a picture here with a classic scenario. Imagine a tax rate changes. It affects a deferred tax asset you have on your books. And that asset was originally created because of a transaction that you recorded in OCI, other comprehensive income, not in your regular net income. So where does the impact of that rate change go? And you guessed it, the answers are worlds apart. Under US GAAP, the default is simple. Any later changes to your deferred taxes, doesn't matter where they came from, they almost always just flow right through the income statement, straight to the P&L. But IFRS does something really different. It uses this backward trace approach. It basically follows the breadcrumbs back to where the transaction started and puts the tax effect there. So in our scenario, the impact would go back to OCI, never even touching the income statement. The bottom line here is huge. This mechanical difference has a direct impact on a company's reported earnings. Because IFRS traces these impacts back to OCI or equity, it keeps them from messing with current period net income. This can make a company's earnings look way less volatile under IFRS than they would under US GAAP, even with the exact same economic events. Okay, we have covered a ton of technical ground. So let's just pull it all together and summarize the absolute must-know differences for any professional who has to navigate both of these worlds. Here are the big five, all in one place. For DTAs, it's valuation allowance versus recognition threshold. For tax rates, it's enacted versus substantially enacted. For allocating changes, it's defaulting to the P&L versus the backward trace. For interim reports, it's a single worldwide rate versus individual jurisdictional rates. And finally, for your uncertain tax positions, the measurement models are different. These 5 points are really the engine behind most of the practical differences you're going to run into. And so I want to leave you with this final thought to chew on. Which of these approaches is actually better? Does having that separate, explicit valuation allowance under US GAAP give investors a more transparent window into management's thinking? Or does the IFRS way of only booking what's probable from the get-go give a cleaner, more direct picture of the likely result? It's a fundamental question about the whole philosophy of financial reporting, and there is absolutely no easy answer.